Okay, let's dive right into this. Welcome to today's Explainer. We're going to decode the hidden algorithm that's quietly controlling, well, almost every aspect of your financial life. We're talking about mastering your credit score. And look, this isn't just about banks and boring paperwork. This is a real, behind-the-scenes look into the numbers that dictate your financial freedom.
So picture this, you've got two people. They have the exact same income, the exact same job, and they live in the exact same city. They both walk into a bank to get a mortgage for a $400,000 house. Buyer A gets approved at a 6% interest rate, but buyer B, they get flat out rejected at first. And when they finally do find an approval somewhere else, it's at a staggering 9%. Why? I mean, it's not because buyer B earns less, and it's certainly not because they're inherently worse with money. It literally all comes down to one tiny 3-digit number.
And what does that 3-digit number actually cost buyer B in the real world? Well, over the life of a standard 30-year loan, that 3% difference in interest equals over $150,000. Yeah, 150 grand. That's not an exaggeration, that's just the raw, brutal math of how interest compounds over time. A single number is literally costing someone an absolute fortune. And that's exactly why understanding what we're about to cover matters so incredibly much to your wallet.
All right, so let's clearly define what this number actually is. Because, a lot of people think a credit score measures how much money you have in the bank. Let me be clear, it absolutely doesn't. A credit score, which generally ranges from 300 to 850, measures one thing and one thing only: how reliable you are at paying back money you've borrowed. It's basically a historical record of your financial reliability. And this number, it follows you everywhere. It dictates your mortgage rate, your car loan rate, whether you get approved for a credit card, and these days, it can even make or break your job applications or whether a landlord lets you rent an apartment. So what actually goes into this calculation? Let's pop the hood and look at the DNA of the credit algorithm. There are 5 main factors that make up the whole, and understanding these 5 specific pieces is absolutely crucial if you want to master the game. So let's break down the biggest pieces first. The absolute largest piece of the pie, making up 35% of your total score, is your payment history. I mean, it's the most straightforward question a lender can ask. Have you paid your bills on time? But the consequences here are severe. Even one single missed payment can absolutely tank your score. And worse, that single mistake can stay on your credit report, just haunting your score for up to 7 years. It is the foundation of your score for a very good reason. Now, the second biggest factor is credit utilization, coming in at a massive 30%. And honestly, this is where most people get things completely wrong. Utilization is simply the percentage of your available credit that you're actually using. And here's the major shocker: using too much of your available credit signals high risk to lenders and hurts your score, even if you pay your balance off in full every single month. No way, right? But it's true. Just the act of heavily utilizing your limit is a massive red flag to the algorithm. So that leaves the remaining 35% of your score. First up, 15% is the length of your credit history. Basically, the longer you've had accounts open in good standing, the better. This is exactly why financial experts are always screaming from the rooftops: never, ever close your oldest credit card. Even if you don't use it anymore, just keep it open. Then you've got a 10% slice for credit mix. Lenders like to see you responsibly handle a variety of debt. A mix of credit cards, auto loans, maybe a mortgage. And finally, the last 10% is new inquiries. Every time you apply for new credit, it pings the algorithm. All right, knowing the theory is great, but how do we actually use this to our advantage? Because let's face it, most online advice just says, hey, pay your bills on time. True, but completely incomplete. If you really want to move the needle fast, you need a targeted strategy. So let's shift from the theory over to the practical playbook. We're going to go through 5 specific insider action steps that can raise your credit score faster than almost anyone tells you.
Action steps 1 and 2 are all about conquering that massive 30% utilization slice we just talked about. Step 1, attack your utilization first. Think about it. If you have a credit card with a $1,000 limit and you're carrying a $700 balance, that's a 70% utilization rate. The golden rule here is to stay under 30% and frankly under 10% if you truly want to maximize your score. Paying that balance down can literally raise your score within a single billing cycle. And step 2, request a credit limit increase on an existing card, but, and this is absolutely crucial, don't use the extra limit. Because the algorithm runs on percentages, not raw dollar amounts, increasing your limit instantly dilutes your utilization percentage. It's a brilliant mathematical shortcut.
Now for step 3, which is commonly known as the authorized user hack. This is a real game changer. If you have a trusted family member with an older credit card, one that has years of perfect payment history, you can ask them to add you as an authorized user.
And the crazy part? You don't even need to hold or use the physical card yourself. The algorithm simply takes their years of stellar on-time payment history and essentially copies and pastes it right onto your own credit file. This piggybacking strategy can give you a remarkably fast and significant boost to your score.
Steps 4 and 5 are really about cleaning house and pacing yourself. Step 4 is to dispute errors on your credit report. You'd be surprised, but studies show a huge percentage of reports contain flat-out errors. Even one incorrect late payment listed by mistake is quietly dragging your score down without you even knowing it. Find them and dispute them. And step 5, just stop applying for multiple new credit cards or loans in a short period. Every single time you apply, it dings your score slightly. While one application is totally fine, stacking multiple hard inquiries close together, that signals desperation and risk to the lenders, and it just piles up the damage to your score.
Now, before we wrap this up, we need to completely debunk a massive myth that holds so many people back. A lot of folks are terrified to check their own credit score because they think just looking at it will lower it. Let me say this clearly. That is entirely false. Applying for new credit is a hard inquiry. That's what causes the temporary score drop we just talked about. But checking your own score? That's a soft inquiry. It has absolutely zero impact on your credit score. None. Zilch. You should be checking your numbers regularly and confidently, not hiding from them out of fear.
Which brings us to the ultimate takeaway of this explainer. Your credit score is not some unchangeable permanent record. It's a highly sensitive algorithm. Unlike your income or your job history, this powerful financial tool can genuinely be improved in months, not years, if you understand exactly which levers to pull. By attacking utilization, leveraging that authorized user status, and fixing hidden errors, you are taking total control of the narrative.
So I want to leave you with this thought. Think back to that $150,000 difference we talked about at the very beginning of this explainer. That is real money being siphoned out of your pocket simply because of a 3-digit number. The rules of the algorithm are laid out right in front of you now. So the question is, are you pulling the right levers, or are you just going to keep paying the price? Take a hard look at your report today. Apply these 5 action steps and take back your financial power. Thanks for joining me on this explainer. And hey, I highly recommend you share this with anyone you know who might be trying to buy a house or a car soon. See you in the next one.